Welcome everyone to Tech Uncensored. My name is Hessie Jones, and today we're talking about transfer pricing for startups who want to expand their businesses globally. So let's construct a scenario for you. You are a Canadian startup. You are developing an eco-friendly smart home device, and you want to contemplate whether or not you want to expand internationally. So you've achieved a lot of great success in Canada, but now you're evaluating whether or not you want to expand to the US or explore opportunities in Europe. So you've done your homework on the markets and you start to determine whether or not there are similar products like yours across border. You've mapped out your competition. You realize that the US market is more established when it comes to smart home devices. And you, through some of your legal investigations, you've determined that there are certifications that you can probably get easier by entering to the US. And based on the regulations, you realize that potentially Canada and the US have similar regulations and may make it easier for you to enter the country from that perspective. EU, on the other hand, you'll start to see that there are significant adaptations that you have to do to the product in order to enter the country in that market. So after consideration, after you've done a lot of your homework, you decide that you want to prioritize expansion into the US due to its growth potential, due to the cultural similarities and logistical advantages. But your homework doesn't stop there. Did you know that unlike Canada's relatively uniform federal and provincial taxes, the US has over 13,000 tax jurisdictions between federal, state, county. They also have political subdivisions for income, state, as well as sales tax. So this is another aspect you have to take in consideration when you want to expand to the US or other international markets. So transfer pricing refers to, and I'm going to read this, the prices charged for goods, services between related entities within multinational enterprise. So that's to say a Canadian startup with subsidiaries or parents in other countries can set transfer prices when trading internally but across borders. So these are the prices. These prices will affect where your profits are reported and how much tax you will pay to each jurisdiction. So I am happy to bring to the table with me Melinda Nguyen-Raybould, who is a transfer pricing partner with MNP's International Tax Group in Toronto. And she helps public and private multinational enterprises, as well as domestic enterprises who want to go international, manage a lot of the complexities when it comes to cross-border intercompany transactions. So we're going to talk about some of the transfer pricing aspects related to entrepreneurs who want to venture out to the US or internationally, things that they have to consider, and how do they minimize the risk or even some of the tax penalties. So welcome, Melinda.
Thank you, Hessie.
So maybe, you know what, maybe I'll ask you, how did you get into this in the first place? What was your interest in this area?
So funny enough, I've never met anybody in transfer pricing that got into it intentionally. My background is in economics, and I did my undergraduate work in economics. So at one point I was looking for potential jobs aligned with my education. This field of transfer pricing came up. I had a friend that was doing it. He explained it to me. It sounded really interesting and sounded like a great way to apply my skills. So that's how I kind of by mistake ended up in transfer pricing, and I've been in it for about 24 years now.
So by mistake, you're actually doing a pretty good job.
Right? I like to think so.
Okay, so let's start with the definition of transfer pricing. I alluded to it a little bit earlier, but I'd like this to come from you. So tell me what it is and why it's relevant to startups who want to expand to the US or even internationally.
So transfer pricing is something that is primarily relevant to multinational enterprises. So that's any group, corporate group that has entities, legal entities in more than one country or legal tax jurisdiction. So what transfer pricing deals with is the pricing, intercompany pricing from one legal entity in the group to another legal entity in the group of tangible goods, services, financial transactions, or intangibles. So any of those things could be sold or provided from one entity in a group to another entity in a group in a different country. And there is a price that needs to be attached to that goods, service, intangible, or financial transaction. So that's what transfer pricing deals with.
Okay. And so why does it matter to startups?
So it matters because transfer pricing impacts how much profit is left in each legal entity in these different tax jurisdictions. So for example, if you think of profit as a pie, and a pie that needs to be shared amongst all of the different jurisdictions where you have legal entities in the groups, the piece of pie that you get is entirely dependent on how you structure and how you price these intercompany transactions. So if you're selling a good from your Canadian parent company to your US subsidiary, if you increase the price from Canada, you decrease the profit in the US. So it matters because it may impact the amount of tax you pay overall, your effective tax rate. And it matters to both the US and Canadian tax authorities, so the IRS and CRA, because it affects how much of the pie they get to tax. So it matters to you because you're trying to manage your effective tax rate, and it matters to the tax authorities because it affects how much they can tax from your profit.
Okay. I want you to explain this notion of this arm's length principle, because this ends up being some kind of cornerstone, I believe,
right,
of transfer pricing.
So the arm's length principle is really the foundation of transfer pricing. So the idea of the arm's length principle is that any intercompany transaction within your multinational needs to be priced at the same terms and conditions that would have existed in identical circumstances between two third parties. So not necessarily what you might view as a market price. There's a lot of things that go into that and lots of factual determination that goes into it. But it's basically to say you're not allowed to just make up whatever price you want. You have to adhere to this concept of the arm's length principle, so that it would have been the same terms and conditions if you had been transacting with a third party.
Okay, so let's go a little bit into what are the different types of transfer pricing methodologies. I know you told me that there are many, but can you just talk a little bit about this?
So maybe at a high level, so certain countries will follow the OECD guidelines, and the OECD guidelines specifies certain transfer pricing methods that apply to these various categories of transactions that could be put in place. Some of these methodologies are what we call transaction-based methodologies, and some are what we call profit-based methodologies, which is a more indirect test of the price. The US is not one of those countries that follows the OECD guidelines, so they have their own set of methodologies for tangible goods and services and intangibles. So it's very confusing because you have oftentimes in different jurisdictions, different methodologies that you need to juggle. So for example, something like the OECD comparable uncontrolled price is probably closest to what you might think of as a market price. Excuse me. So comparable uncontrolled price is a comparison of an identical good, service, or intangible in identical terms, conditions, business circumstances, etc. So you may ask a question. Give me a second. So you may ask the question, how much is the price of an apple? And so if you're trying to apply the comparable uncontrolled price, you need to understand, well, what kind of apple? Is it a red apple? Is it a green apple? Is it a Honeycrisp apple? Is it a fresh apple? Is it, a 2-month-old apple? Where are you selling this apple? Is it being sold in Germany? Is it being sold in Toronto? Is it being sold in Alaska? And then finally, at what level market is it being sold? Is it being sold at a retail level to a customer? Is it being sold wholesale? So all of these factors will play into how you determine what the comparable uncontrolled price is and what prices you can use to compare to your apple. So it, it literally needs to be an apples to apples comparison.
Okay. So let's take, for example, the software, technology software industry, because this is what's most relevant to many of our startups. We're dealing with intangible assets like intellectual property and software and patents. And so when it comes to pricing, how does transfer pricing impact what technology startups use when they price their services abroad, taking these kinds of things into consideration?
Mm-hmm. So it really depends, right? So the foundation of kind of transfer pricing, determining how you comply with the arm's length principle, is the facts and the economic circumstances. So for example, we refer to something called a functional analysis. So that is, what functions are each entity to the transaction undertaking? What assets are they employing? So who owns the IP? Who has, machinery, tangible assets, and what risks they're assuming. So that's all very important into making that determination. Then we also have to consider the broader economic circumstances and the business strategies you're employing. So for example, is your strategy to try to penetrate the market and push out your potential competitors? Is your strategy to build your presence first and make your brand known with a first generation product before you launch a different product? So there's a bunch of things that come into play. And then once we understand those facts, we can look at what is the appropriate methodology that we need to apply based on our understanding of the facts. So it can vary from, company to company. We can have 10 clients or companies that have the same transaction in place and have 10 different answers, because the facts and circumstances are a little bit different in each one.
Do you happen to know whether or not, let's say, IP registration in your domestic country, it is different than if you had also registered it in the country that you want to expand to?
So I think maybe what's helpful to understand in transfer pricing is that the concept of registering your IP is a legal concept, right? So legal registration and ownership is kind of one aspect that we look at in transfer pricing. We also look at what we call economic ownership. So who has contributed to the value creation of IP? So you may have registered the IP in your home jurisdiction, and you may legally feel that you own it and you in a certain jurisdiction, but if the work to develop it has been done in a different jurisdiction and it has not been compensated for, and that other entity is like an investor who's put sweat equity into developing the IP, now they partially economically own that IP. And we do see that a lot with startups, where we have kind of messy shared ownership of IP between jurisdictions, because nobody thought about, well, do we need to worry about compensating that other entity as a contract R&D service provider so we can maintain our economic ownership along with our legal ownership in a different jurisdiction?
Okay. Yeah, that sounds really complicated. So I'm going to throw another one at you, because there's a lot of businesses that in tech that have a business model known software as a service. And so how do you price something like this when, let's assume that from a cost of goods sold perspective, the the entities that are even working, maybe that's not even a cost of goods sold, but the employees are situated either remotely, domestically, or they're spread all over the world. So how does that play into the transfer price, or does it?
It does. So there's a couple of things, again, going back to this concept of we need to understand the facts first. So in terms of the facts, are these employees of, you could have employees of the Canadian company spread all over the world, right? Or contractors that work for the Canadian company spread all over the world. So who are they employed by? That would be the first question. Factually, we need to understand that. Secondly, let's say if they're employed by these legal entities, what exactly are they doing? What functions are they undertaking? And how are they contributing to the business? So that's another thing that we need to understand. So if we have employees who are employed by legal entities spread throughout the world, that means that if we look at that pie again, the concept of splitting up a pie, we may have to give at least a sliver of the pie to each of these jurisdictions because they're doing something to economically contribute to the business. So that's what that really means. But we also looked again to where these, who employs these employees, and whether they're employed by the local legal entity or whether they may be, let's say, an employee of the Canadian company who's living in Mexico.
Okay, got it. Okay, so earlier I alluded to the fact that the Canadian legal, I guess, are taxing as well as our legal our laws. So are sort of unified or harmonized across our provinces. It's different in the U.S. I see this all the time, but even from a taxing perspective, there are 13,000 jurisdictions, taxing jurisdictions, and they're all different or modified depending on sales and other taxes, but even between a county and a state level. So tell me about, I guess, the implications of pricing implications either at the federal level or the state level, specifically, let's say in the U.S.
Mm-hmm. So at sort of at a broad level and starting at the federal level first, so your transfer pricing will impact the overall amount of tax that your U.S. entity will pay at a federal level to the IRS. Oftentimes with the states and other jurisdictions below the states, they look to your federal income first to then decide how they're going to tax it at the state level. So while transfer pricing is primarily concerned on a cross-border basis with how we're taxed at the federal level, it can have a trickle-down effect of how that income is now taxed at the state level. And then in addition to that, there's a kind of very interesting arm of transfer pricing within the US where certain states, and it's becoming much more of an area of focus now, are looking into state-to-state transfer pricing. So while we've been mostly talking about, let's say, a Canadian company that sets up a subsidiary in the US and is selling products to the US, within the states in the US, you could have a legal entity, say in Virginia, selling products to a legal entity in California, and there may be intrastate transfer pricing issues. And at the state level, a lot of these jurisdictions have been hiring and employing more examiners to look at this state-by-state transfer pricing issue.
Okay. So I want to get into a scenario when there's a potential that an entity exposes itself to tax penalties because of non-compliance. So let's use the same scenario where we're talking about a startup that wants to enter the US in the smart home devices area. They reside in Canada, but they set up a subsidiary in Florida. So the corporate rate in Florida is much lower than it is in Canada. So they proceed to sell the product from Canada to the Florida entity. And then from Florida, they sell it across the US at a much higher price than they would do domestically. What could be the potential problem here?
So the implication of your scenario right there is that the US might be earning a lot of profit, maybe let's say very little profit or no profit in Canada. So my answer to the question is it always depends. So whether that scenario that you presented is a problem really depends on what functions each of these entities are performing, what assets they're employing, and what risks they deploy. So an example of where this definitely would be an issue is if you have a legal entity in the US that is a shell corporation, there's no employees in it, there's no meaningful functional activity going on in that corporation, and you're using that corporation just as a means to sell to your US customers. So it takes flash title of the goods while it's being shipped directly from the Canadian company. It's not doing anything, yet it's earning a lot of profit. So if the Canadian authority, the CRA, were to audit the Canadian company, they might look at this and say, well, we disagree with selling this at such a cheap price to the US entity. And we think that instead of, say, $10 per unit, the price should have been something more like $80 per unit. And therefore, your profit or your piece of the pie should have been much bigger than what you actually left here. And we will reassess you and adjust that pricing and then tax you on the additional profit that we think you should have paid in Canada. And so then there's A, the risk that you have to pay additional tax when you don't expect it. B, if that adjustment is large enough, there could be potential transfer pricing penalties. So in Canada, if you have an adjustment that breaches the penalty threshold, which is the lower of Canadian $5 million or 10% of your gross receipts, that adjustment amount will be subject to a 10% penalty in addition to any additional tax that you owe. And then on top of that, you now have the problem of, well, you've already paid a bunch of income tax to the US, and now you have income that's been double taxed. And there is a process, a competent authority process that you can go through to recover the tax that you paid on that income to the US. However, that process is lengthy, it's expensive, and it's definitely not something that you want to tie up your time and resources as doing as a startup.
Okay, so you mentioned some of the penalties. Are there more than that? I guess that everything is situation dependent, but I would assume that there are much more penalties depending on what kind of exposure of the situation has happened.
Yeah, so on the other end, like if we flip the jurisdictions around, there could have been penalties in the US. So if we just switched the scenario and flipped it around, if we're dealing with, let's say, royalties, other things that are subject to withholding tax, there could be additional withholding tax owing. Depending on how badly you got the answer wrong, there could be other penalties as well. So there's a lot of different implications, not just the transfer pricing penalties, but you could have kind of ancillary additional taxes or penalties owing from getting your transfer pricing wrong.
Okay. So what do startups need to do to equip themselves to make sure that they remain compliant, especially once they determine that I want to do business in this market? What do they need to do?
So I think the first thing is being aware that transfer pricing is an issue and that it exists, and that as soon as you start setting foot with another legal entity in another jurisdiction, whether that's the US or someplace in Europe or someplace in Asia, you now have transfer pricing. Whether you want to acknowledge it or not, you have a transfer pricing issue. So that's the first part, is acknowledging that once you start setting up new legal entities outside of your home country. The second is really to likely engage with an expert. So this is a complicated field. We like to think of ourselves as a black sheep of tax because it's very much a field based on economics. So it's very difficult. I often talk to startups who say, we're using a market price. We just priced this at the same price we're using in the market, or this is the market price that we see. Oftentimes, the way that we get to what the actual price should be is very complicated, and there's a lot of factors that you may not be aware of. So it's a little bit of, you don't know what you don't know. And what may seem kind of common sense and reasonable and rational to you may not actually work from a transfer pricing perspective, because we go into levels that you may not kind of really understand. So the biggest thing is, being aware that this is an issue. When you're going to another jurisdiction and setting up a new legal entity, you should talk to your advisors and understand what the potential transfer pricing issues might be, so that you can proactively manage both your effective tax rate and make sure that you're not causing any major penalty risks through non-compliance, or potentially creating a penalty risk or an exposure that, on exit, if you're trying to get acquired 5 years down the road, that a potential buyer might say, oh, I don't want to inherit that mess, or leave you having to make representations against any of these tax liabilities you might have.
Okay, so it's fair to say that as much as startups may understand some of these concepts that we're talking about today, they can't do it on their own. They'll need the experts. Okay.
Yeah.
Okay, perfect. One last question, and I think this is the question that interests a lot of our startups because of the latest news that came out of the U.S., where there could be a potential imposition of 25% tariff on Canadian products and services. And this will have potential consequences. It will have consequences. Let's just say, we know that it's going to have consequences for any startup who wants to sell into the U.S. So, can you tell me a little bit about the sectors that are primarily impacted by this, and what are the implications for startups who had planned on actually expanding next year?
So the issue, and full disclaimer, I'm not a customs and trade expert, but the issue is that the value of a good coming into the U.S. Is important. So in that world, there's a whole different set of methodologies they use to value a good coming into the U.S. But oftentimes we're starting from the transfer price. So if you're selling, let's say, your smart home device from your Canadian parent company to your U.S. distribution subsidiary, the price that you are selling that smart home device at will have an impact on how much of that, what value can be subject to duty or different tariffs. So that's kind of where transfer pricing intersects with that. It's, I think, as I understand it, maybe a little bit unclear what sectors may be affected by that, and that's to be seen. But anybody that's selling a product intercompany cross-border to the U.S. will need to understand how they personally are affected by it, and probably start thinking about how best to prepare for that now.
Yeah, it's definitely going to be a competition, and they may be priced out of the market. Who knows? It'll be interesting. Well, I think that's all we have time for today, and I thank you so much, Melinda, for joining me. This is a complicated topic. I'm starting to realize as I even was researching this a little while ago, that it isn't as easy as it seems. That pricing strategies domestically is a whole different kettle of wax when you actually go internationally. So thank you for providing us with your wisdom and knowledge on this topic.
Thank you for having me.
No problem. And so for our audience, if you have topics that you want us to explore, please email us at communications@altitudeaccelerator.ca. Tech Uncensored is powered and is produced by Altitude Accelerator, and we are hosted on Spotify. And you can find us wherever you get your podcasts. In the meantime, until next year, everyone have fun and stay safe.